Institutional and retail investors are actually betting against the stock market despite the hefty returns we've seen since the start of the year. Yes, folks, believe it or not, despite the performance of the likes of Meta, Amazon, Google, Microsoft, or even Nvidia so far this year, most investors are still relatively bearish on the prospects of the stock market over the next 12 months. And for the very first time in a very long time, it's a consensus between both retail and institutional investors where put-to-call ratios have just hit near 1.2 on the S&P 500, and short interest in some of the biggest small-cap companies is hitting an all-time high. And as somebody who personally invests a lot more in those smaller companies, particularly in the energy, renewables, and electric vehicle space, I've been experiencing this disappropriate performance firsthand over the past 2 months. So what exactly does this poor sentiment in the short term foreshadow for stocks over the long term? Well, folks, that question is exactly what we're going to try to break down in this video. But as usual, folks, before we get into it, make sure to drop me a thumbs up and hit the subscribe button if you haven't already. First things first, folks, let's put into perspective yet again the underperformance of small companies versus the large companies so far in 2023. As you can see, the ratio of the Nasdaq 100 to the Russell 2000 has just broken past the highs we saw in the dot-com bubble to almost 9.13. What this basically means, folks, is that since most indices are weighted towards its largest companies, the index is by far performing a lot better than some of the individual companies that index is supposedly supposed to represent. The number of Nasdaq stocks above their 100-day moving average is falling to a near all-time low. Meanwhile, the market is making new near-term highs. And as multiple data sets are showing us, we have never historically in modern stock market history ever been in this kind of situation, where only a small number of companies are performing well, whereas basically every other company in the area is performing really poorly, not only from an earnings basis, but more importantly from a market valuation. And what this is all turning into, folks, is this inherent recency bias against smaller companies. With rising interest rates, speculations have been growing significantly that a lot of these small companies are likely going to go bankrupt, are going to have to raise more capital, won't be approaching their gross margin positives, or even missing earnings estimates for new quarters. And this is simply leading to their PE and price to sales ratios hitting new lows from the average that we've seen since 1985. Now, don't get me wrong, folks. On one hand, this makes sense because smaller companies are much more influenced by market interest rates, and they're simply much riskier to invest in the first place, which is exactly what you don't want when mortgage rates are at 8%. But although I will most likely sound like a broken alarm clock, I think this is opportunity instead of time to go haywire. And the first and potentially most obvious reason for why I believe that, folks, is because short interest is rising like never before in some of these small companies, which means that the majority of the crowd is sitting on one side of the boat. What I mean by this analogy is that if everybody is sitting on one side of the boat, then there's a high likelihood that the boat is going to flip over. And as a result, a return to normalcy is most likely in the books, even though in the short term, obviously, it does not feel like it is. There are more than 539 stocks trading under $1 right now in 2023, with more than 102 having done reverse splits since September 5th. This is pure decimation in small cap land, and for those who weren't around in early 2021, there was a time when there were barely 4 to 5 stocks trading under $1. According to experts and historians in the space, these are numbers from 2008, with nowhere near the economic damage that was being done back then. Yes, inflation is high. Yes, the cost of running a business is also high, but at least we don't have a banking crisis where most credit default swaps and mortgage-backed securities were all of a sudden found to be completely worthless. A lot of these shorted stocks are now starting to rally, and the chances of us seeing a squeeze that lasts more than a month is increasing every day that we see more and more of these stocks hit 52-week lows. Because as it turns out, the price action for a lot of these smaller companies is being determined not by investors, but by actual traders, which are typically running off of algorithms and independent data that comes out basically every single day. That data allows them to decide whether or not it's a good idea to short these stocks, and because most retail investors have flocked out of the market over the past 2 to 3 months with record outflows in the billions of dollars in August and September, there really is no shareholders to hold the value of these companies, which are now in the hands of traders. But the most important part that many such investors tend to forget to address is the idea that small companies often provide the best shareholder returns if you know how to pick the right ones. The fact of the matter is, folks, the bigger the company, the more opportunity for losses you actually have from a probabilities standpoint. Case in point, Tesla shares, for example, are exactly at the same point they were 3 years ago in December 2020 as they are right now. Meanwhile, the company's revenue went from 31 to 100 billion and profit from 24 cents to $3.14. Yet the stock during the same time is almost down. And for those of my fellow investors who understand the efficient market hypothesis, I'm sure you can relate to the fact this has everything to do with valuation multiples. Tesla's price to sales, forward PE metrics are simply way too high to really give any meaningful shareholder return over the next 5 years compared to where the company has been over the last 5. Similar to the likes of Nvidia, the company's stock ran up so fast, so quick, that it priced in the growth the company is currently experiencing more than 2 to 3 years ago, which just so happens to be the exact opposite phase that small caps are currently in. Meanwhile, folks, these companies are actually hitting all-time lows at a time when their revenues are also growing and profitability expectations are improving as they gain market share and economic throughput increases. Now, yes, there's certainly going to be a lot harder to pick the right companies in this broader bear market, but the opportunity for returns, especially if you hold long enough, is much higher, in my opinion, than buying large cap stocks like Tesla, Nvidia, Microsoft, Apple, or Google. The data tends to agree with my hypothesis, with the 4P of the Russell now sitting at 12.26, hinting that annualized 10-year returns could be in the double digits. But as usual, folks, let me know your thoughts down in the comment section below. Thanks a lot for watching, folks, and I'll catch you guys in the next one. Take care.